Welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what the investors are thinking about right now and how that fits in with building the right portfolio. So in this episode, I want to discuss three market events which I think are still highly relevant to investors in Asia Pacific. Of course, the latest developments in the U.S. Iran war, central bank's reaction, and also the first quarter corporate earnings in the U.S. So let's start with the conflict in the Middle East. Now, there is a ceasefire in place and negotiation seems to be ongoing. But we should not underestimate how challenging this negotiation is going to be. The level of trust between the two sides is relatively low, and negotiation of this nature is very complex, and it is going to take time. Opening the Strait of Hormuz has been mentioned a few times by both sides, but we look at what the numbers are telling us instead of what the two sides are saying. Various shipping statistics show that traffic through the strait is still about 90 to 95% below the pre-war level. Looking at the price action for both oil and stocks, investors seem to think that the impact from the blockade can be quickly reversed, and they are somewhat impatient to deploy the cash on hand. If both U.S. and Iran can guarantee the safety of traffic through the strait, it will still take several weeks at least for energy and other essential raw materials to resume normality, given how much time is needed to load and unload. The stress on the global economy will come in phases. The shipment departed the Middle East region before the war began would have been just delivered in the last couple of weeks. So supply disruptions could start to bite now. Airlines in Europe and Asia are already reducing their services due to higher fuel costs and shortages. They're also passing on higher costs to customers via surcharges. 20 to 30% of fertilizer ingredients such as urea, ammonia, and sulfur comes from the Gulf region. This would impact on food production as farmers in the Northern Hemisphere are starting to plant their crops. Some may opt for crops that require less fertilizer, such as soybean. This implies the inflationary impact from food may be lagged to later this year. So it is rather early to declare the all clear on the risk of stagflation. But governments do have some room for fiscal support to dampen the inflationary impact. This includes the U.S. government tax rebates currently that's reaching households as we speak. For central banks, the Federal Reserve seems to be happy to just wait and see. The futures market is not expecting the Fed to change its policy rates in the upcoming April FOMC meeting. In fact, futures are pricing in a small chance of a rate cut later this year. In Japan, Euro area, and the UK, their central banks have relatively a more hawkish tone than the Federal Reserve. But senior officials from these central banks all prefer to adopt a wait-and-see approach as well, since the situation in the Middle East can be highly uncertain. So an interest rate increase in April seems unlikely at this point. Given monetary policy takes at least 6 to 9 months to work through the economy, central bankers will need to have a good level of confidence that inflation pressure will stay elevated by the end of this year and early next year for their rate hikes to be justified. For Asian central banks, the oil import dependence relative to the size of the economy could drive their response. For economies to be more driven by tech exports and services, such as Taiwan, South Korea, Singapore, their central banks have room to stay hawkish as the damage to growth is more manageable. In fact, the Monetary Authority of Singapore recently tightened policies in April. For economies with a greater vulnerability towards imported oil may need to show greater urgency to support their economies. This will include India, Thailand, and Indonesia. However, these central banks could also face the additional challenge of currency depreciation if their central banks opt for aggressive rate cuts. Hence, the magnitude of easing could also be constrained. So I think the volatility in energy and risk assets is likely to remain as we've been highlighting in the recent weeks. Central banks are also not rushing to raise rates aggressively, which helps to limit the downside in fixed income, as well as negative pressure on equities from higher rates. Nonetheless, it's still quite surprising to see how the market behaved in the past 2 weeks. The Nasdaq index is 18% higher than the low on March 30th and 8% higher than before the conflict began. We saw a similar pattern with S&P 500. Now, we do agree that markets should not be overly pessimistic because of the war in Iran, but at the same time, is the market being too complacent? Well, at least for now, investors have a good reason to stay positive with US equities. First quarter earnings for S&P 500 is expected to expand by 12.6%, or 6 consecutive quarters of double-digit growth. The pressure from the war may take longer to be reflected in earnings. Moreover, some sectors are considered to be more resilient under geopolitical uncertainty. The development of AI is driving demand for semiconductors. AI hyperscalers are still expected to generate healthy earnings growth, even though investors are still focusing on their capex spend and the future returns of this investment in compute power. But this is not just a story about AI. Industrial companies, especially those linked to national defense and financials, are also expected to post strong earnings. For banks, investment banking activities such as IPOs and also the rise in trading volume during the recent bout of market volatilities could provide upside surprises to earnings. So we have a somewhat confusing backdrop of geopolitical volatilities, but with solid corporate earnings. To us, diversification is still the key for investors to navigate this environment. A broad allocation in US equities beyond technology, and also a focus on Asian markets makes sense for equity allocation. For fixed income, short duration government bonds and high yield corporate debt is a good combination to generate income, but at the same time, manage exposure towards inflation surprises and the prospects of higher fiscal deficits because of spending to support households and businesses. Alternative assets, such as infrastructure and transportation, are natural ways to hedge against the current bout of geopolitical uncertainty in the Middle East as well. So thanks for listening. I hope you found this useful. If you do, please consider subscribing and, of course, share this with your friends and colleagues. If you have any questions for us, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.